Welcome to Talk Tickers. Today we're diving into Southside Bank's latest earnings, and wow, did the headline numbers create a puzzle for investors. The bank took a big strategic loss, which raises the key question. Was this a brilliant long-term move, or is it a sign of trouble? Let's break it all down.
Okay, let's get right into it. The numbers from Southside's October 24th call, well, they look totally contradictory at first glance. On one hand, you have the official GAAP earnings per share, a pretty meager 16 cents. But on the other hand, the adjusted number, the one analysts really care about, was a very solid 80 cents. This massive disconnect, well, that's the whole story right there.
So, to really understand why those two numbers are worlds apart, we first need to look at the conflicting headline results.
And here's where you can really see that contrast in detail. That adjusted EPS of 80 cents, that actually beat what analysts were expecting. But at the same time, the official GAAP number got clobbered. Their net interest income came in just a little shy of estimates, and the net interest margin tightened up a bit. It was, a truly mixed bag of results.
So what in the world caused that huge GAAP loss? Well, it wasn't an operational failure. No. This was a deliberate, strategic move by management to reposition the entire bank for the future.
They decided to take a calculated hit. The bank went and sold off $325 million of securities from its portfolio that just weren't earning much. Now, doing that created a big, one-time loss, but the whole goal here was to improve their earnings for the long haul.
And this wasn't some accident. It was a carefully planned, multi-step maneuver. First, they sell those underperforming assets. Second, they booked the $24.4 million loss, which is what just tanked the GAAP earnings. Third, they take all that cash and reinvest it into stuff that actually makes them more money. And finally, the intended result, a big boost to their future net interest income.
And management was really clear about the timeline on this strategy. The CEO, Lee Gibson, he told investors he expects to make back this loss in less than 4 years. So in short, they're asking the market to accept one bad quarter in exchange for a much healthier, more profitable future.
And while that big one-time charge was dominating all the headlines, the bank's actual core business, it was showing some pretty impressive momentum. And this is the part of the story that management really wants investors to see.
First up, loan growth was robust. The bank added $163 million in new loans just during the quarter. That's a strong 3.5% increase.
And this was supported by something even better, deposit growth of 5%. In today's environment, being able to attract and keep deposits, well, that's a key sign of a really healthy and trusted bank.
Looking ahead, management signaled a ton of confidence. They expect their net interest margin to be up slightly in the fourth quarter, and for net interest income to see a nice improvement. Which, hey, that's the direct payoff from that whole restructuring plan. Plus, their loan pipeline is still looking strong at $1.8 billion.
So, despite this positive underlying story and all this confident guidance, the market's reaction was, well, to put it mildly, they were not convinced.
Get this, Southside stock actually fell 0.5% on earnings day. And what makes that really stand out is that the broader regional bank index, the KRE, rallied almost 2% on the very same day. That underperformance is a crystal clear signal of some serious investor skepticism.
Which brings us to the crucial question that I'm sure investors are asking. If this strategy is so sound, why on earth did the stock drop?
And here's the disconnect. It all boils down to this. Management is telling a story about a smart, strategic pivot for long-term growth, but the market is responding with a very clear message: show me the proof. Investors want to see the benefits in the actual numbers before they're willing to buy into the narrative.
So, given all of that context, here is our take on what comes next for Southside Bank shares and exactly what we'll be watching for on their next call.
On the next call, we're going to be looking for proof in 4 key areas. First, do the Q4 results show a real improvement in net interest income and margin? Second, are funding costs staying under control? Third, what's the impact of their upcoming debt repricing going to be? And finally, how is the new CEO, Keith Donahoe, executing on this strategy?
Based on all this, we are initiating coverage with a market perform rating.
Right now, there's a bridge of what we call execution risk between the sound strategy and the proven benefits. The stock is probably not going to outperform its peers until the bank delivers a really clean quarter that shows this whole balance sheet reset is actually paying off.
Okay, and now for our outrageous but plausible trade idea, pitched just like an analyst would to an investment committee.
And first, the mandatory disclaimer. This is not financial advice. It's for informational and educational purposes only. Please do your own research.
The pitch is that this whole balance sheet cleanup has created what you might call a coiled spring. We think the market is unfairly punishing the stock for a smart long-term decision. A single, clean earnings report in January showing that the strategy worked could be the catalyst that forces a significant upward re-rating as all that skepticism just evaporates. The trade would be to use call options to capture that potential upside with defined risk.
So, the big takeaway is whether this near-term pain really does set them up for long-term gain. Is Southside a value trap, or has it just pulled off a very smart pivot? The next earnings call, that's going to give us our first real answer. This is not financial advice.